Let's get across the market open now. Kyle Ryder joining us from capital.com. Kyle, welcome to Monday. And well, let's start first what we saw on Friday. Look, global markets essentially remaining in a bit of state of flux, certainly over that news flow out of the Middle East. And now, of course, we have more news. President Trump essentially rejecting that proposal from Iran.
Indeed, and it still seems that, more or less the conflict is at a stalemate for now. But looking at the initial moves today, this so-called Project Freedom of trying to release some of these trapped tankers in the Strait of Hormuz has put a little bit of downward pressure on crude futures, and the initial moves are obviously pretty positive for US futures and equity futures in Asia as a result. So there still seems to be some lasting hope that things will not escalate further, that some kind of peace deal will eventually arrive. And, this Project Freedom probably kicks the can down the road just a little bit, enough to buy some extra time, considering that the global economy is still sort of heading towards this potential supply cliff in global energy markets, which, of course, is going to have some kind of impact and will have a bigger impact the longer that it's drawn out.
Meanwhile, of course, we've seen Wall Street continue to set new records, particularly driven by those tech stocks. Is there any particular risk ahead in terms of perhaps that unwinding? What are we seeing? Because certainly the momentum continues.
Momentum continues, and I think, if you want to put a finger specifically on why Wall Street's at record highs, despite what was at the margins, probably a little bit of central bank policy uncertainty last week, and going forward, of course, too, and, the fact that these geopolitical risks still seem to be simmering away, and higher energy prices in principle should, impact corporate profits going forward, is that the results for Q1 for S&P 500 companies has been nothing short of extraordinary. The market is on course for 27% earnings growth for the period. That's contrasted with a pre-earnings season estimate of about 13%. So companies have absolutely smashed it out of the park. And owing to a little bit of base effects too, Q2 results are looking like they'll have another basically 20-something% earnings growth as well. So the numbers from the tech companies last week were strong on balance. It's expected that across the entire market, profits are going to be, again, nothing short of extraordinary. And some people are scratching their heads when it comes to why Wall Street's at record highs at the moment. If you need a simple answer, it's simply profitability and what has been just absolutely stellar earnings growth and expectations of what is expected to be stellar earnings growth going forward as well.
Now, Kyle, meanwhile, focus this week here in Australia very much on that RBA decision tomorrow. I think markets pricing in around a 75% chance they will hike again. If not then, 100% by June.
Yes, and I think, maybe the discussion like last meeting will be centered around the question of not, if the central bank hikes interest rates, but when it decides to hike interest rates. And, really that market pricing does suggest that really there's not that much of an impediment for the RBA to hike right now. And the reason for that is that the labour market is in still a fairly resilient state, and there is this persistent supply-demand imbalance in the economy that is keeping inflation above target and potentially pushing it further above target, or inflation will push further above target by virtue of this supply shock coming through because of energy markets. So it would appear that the foundations are set for a rate hike tomorrow. Once more, if it doesn't go then, it almost certainly goes to the next decision. Perhaps once more, the real interest will be in the vote split, because almost certainly if there was division last month and some advocating for a sort of a more slow approach to hiking interest rates, while others, were obviously much more in favour of greater urgency, that could be where the sort of devil is in the detail. But on the balance of probabilities, inflation's above target. The labour market isn't any sort of an impediment to tighter policy at the moment. So it would be very surprising, in my sort of very humble opinion, if it didn't hike interest rates tomorrow.
What do you see as the risks for the local market? I mean, clearly that is dragging on sentiment. We have seen the Australian market underperform. And then, of course, next week we get the budget.
We do, and I think the risks here is that the domestic economy is relatively sluggish. that the global economy will take a modest hit because of the energy crisis, if nothing else, perhaps worse than that, and that we're in a higher and rising interest rate environment, meaning that, the kind of underperformance that we've seen from the ASX 200 compared to other parts of the world is likely to persist. If we get sort of solid financial conditions across the world and strong sentiment, that is driven by or helps even lead Wall Street to record highs, then that's going to put some support underneath the market. But when you do, again, talk in relative terms, the fundamentals here aren't fantastic. One of the reasons why we were testing record highs at the start of the year was because of that global rotation into cyclicals, on the point of view that many central banks would be cutting interest rates, chiefly the Fed, obviously, and that we might see, a little bit of a pickup in global economic activity. The energy crisis has really watered that down, if not kind of killed it entirely. So there's not that many drivers of ASX 200 strength at the moment. The macro and the micro doesn't stack up particularly well. And if there's anything that's going to drive upside, and from an absolute perspective, it's if global markets remain fairly ebullient. And even in that situation, I suspect it will underperform global counterparts, again, just because our fundamentals just don't stack up as well as compared to other major benchmarks.
And Carl, the prospect of further rate hikes certainly buoying the Aussie dollar at the moment. Is that likely to continue, do you think?
As long as geopolitical risk remains fairly subdued, then certainly it would seem interest rate differentials are going to win the day and push the Aussie dollar higher. We're not far, as of this morning, from fresh 4-year highs, and the fact that, if the energy crisis remains subdued, it will mean that, rates are still going to go higher here in Australia, almost certainly, but rates in the United States will probably remain unchanged, and there'll even be talks about potential interest rate cuts there once again too. So that dynamic alone is going to really support the Aussie dollar. The big swing factor again is if things escalate in the Middle East, we see that conflict arise once again, and we see sort of the war trades emerging once more, one of which is a stronger US dollar vis-a-vis a higher oil price, then that might sort of hit this kind of upward trend that we're seeing in the Aussie. But again, that aside, the fundamentals are fairly supportive of the Aussie. And again, if we get a rate cut tomorrow rate hike tomorrow in the very short term, that sort of, call it 7 basis points, 6 basis points of hikes that currently aren't in the price will have to be priced in. And that might be the push that we see to get the Aussie dollar to, again, another fresh 4-year high.